Have you ever been in that painful situation where you had to repay a bonus from a previous year? It's the worst. The money's gone, but you've already forked over the income tax on it. So how do you get that tax money back? In this explainer, we're going to dive deep into a specific part of the tax code that's designed for exactly this problem. It's called the claim of right doctrine.
So you repaid a bonus, and your first instinct, your gut reaction is probably, I'll just amend last year's tax return. It seems like common sense, right? Well, you'd be wrong. In fact, it's legally not allowed. So what on earth are you supposed to do? The answer is hiding in a really powerful and honestly pretty misunderstood part of the tax code.
All right, so to really get the solution, you've got to understand the problem first. Let's take a look at the foundational legal principles that actually stop you from just filing an amended return. The entire U.S. tax system is built on this one bedrock idea, the annual accounting principle. All it really means is that we handle taxes in neat, tidy, one-year blocks. Once December 31st hits, the books for that year are, for the most part, closed. This keeps the whole system from falling into chaos, but that rigidity is exactly what creates this bonus repayment headache. This leads us all the way back to a 1932 Supreme Court case that set up something called the claim of right doctrine. The court's ruling was pretty clear. They basically said, look, if you get paid and you have the right to use that money however you want with no restrictions, then it's income for that year. You have to report it. It doesn't matter if you might have to pay it back someday. That's a totally separate issue for a future tax year. So here's the absolute key takeaway. That tax return you filed back then, it was 100% correct. You were legally required to report that bonus as income. And amending a return, using a Form 1040-X, is only for fixing errors. Since you didn't make an error, you can't amend. The repayment is a new event that you have to deal with in the year it happens. So if amending is off the table, what's the move? Are you just out of luck? No way. Thankfully, Congress saw how unfair this could be and created a very specific tool to fix this exact problem. And that tool, that fix, is Internal Revenue Code Section 1341. I want you to think of this as a special relief valve built right into the tax code. It was designed to give you a fair shake without breaking that whole annual accounting principle we just talked about. It lets you get your tax money back without reopening a closed case, so to speak. Now, before we get into the nitty-gritty of how it works, there's one number you absolutely have to know. It's a critical threshold, a magic number that completely changes how the law treats you. And that number is $3,000. Okay, you're going to want to lean in for this part because the difference is like night and day. If you repay $3,000 or less, Section 1341 doesn't even apply to you. You're supposed to take a miscellaneous itemized deduction. But, and this is a huge but, the Tax Cuts and Jobs Act, the TCJA, suspended those deductions under IRC Section 67G from 2018 to 2025. So for most people, there's no tax help for these smaller repayments right now. But if you repay more than $3,000, it's a whole different ballgame. The full power of Section 1341 is unlocked. You get a choice of a deduction or a credit, and that deduction is specifically protected from that TCJA suspension. This is a massive, massive difference. So for those bigger repayments, Section 1341 gives you a choice. But it's not really a casual choice you can make on a whim. You're actually required to run the numbers two different ways and then use the one that gives you the better result, the one that leads to the least amount of tax. Let's break down these two methods. Method 1 is the deduction as laid out in IRC Section 1341A4. It's pretty straightforward. You just deduct the full amount you repaid on your current year's tax return. It goes on Schedule A, line 16, and you need to be sure to label it IRC Section 1341 repayment. Now, while this deduction survived the TCJA, its benefit can be totally wiped out if you just take the standard deduction, which so many people do now. And that weakness of the deduction brings us to Method 2, the credit, under IRC Section 1341A5. And let me tell you, this is almost always the winner in today's tax world. Instead of just reducing your taxable income, this method gives you a direct dollar-for-dollar credit against the tax you owe this year. It's way more powerful. Okay, let's walk through this. It looks a little complex, but it's just a logical four-step process. Step 1, figure out your tax for the current year, but pretend the repayment didn't happen, no deduction. Step 2, now go back to that prior year's return and refigure the tax, but this time you remove the bonus from your income. This is just a what-if calculation. You are not actually filing an amended return. Step 3, take the tax you actually paid that year and subtract the new recalculated tax. That difference right there, that's your credit. And step 4, you claim that credit on your current year's return on Schedule 3, line 13B. Let's put some numbers to this so you can see why this is such a game changer. We'll call this the Standard Deduction Trap. Imagine, back in 2021, you made $150,000, which included a $50,000 bonus. Your tax was $25,000. Now you repay that $50,000. To calculate the credit, you refigure your 2021 tax as if you'd only made $100,000. That tax would have been just $13,000. The difference, $12,000, is your Section 1341 credit. If taking a deduction this year gives you zero benefit because of the standard deduction, this $12,000 credit is pure gold. It's real money back in your pocket. Okay, so solving the federal puzzle is a huge win, but we're not quite done. It's often only half the battle. Remember, you also paid state income tax on that bonus, and the rules are different everywhere, so let's use California as an example of the kind of craziness you might have to deal with. So California agrees with the federal rule, but how you actually claim it is unique and trips a lot of people up. You have to do a whole separate calculation using California's old tax rates. Then, and get this, you don't claim it on a normal schedule. It's a write-in credit on Form 540, line 78. I mean, you literally have to write IRC 1341 and the credit amount right on the form. This is a major headache for online tax software. You often need to use a desktop version or attach a special PDF to get it done. Whew, okay, that was a lot of technical stuff, I know. So let's boil this whole process down into a clear, step-by-step action plan you can actually use. Here is your game plan. Step 1. First things first, make sure you're even eligible. Is the repayment over $3,000? Was the money held under a claim of right? Check. Step 2. Get your paperwork together. You need that old tax return and proof that you paid the money back. Steps 3 and 4. You have to do the math both ways. Calculate the deduction and calculate the credit. Step 5, compare the two results and pick the winner, the one that saves you the most money. And finally, step 6, file your returns correctly, using the right lines and, to be safe, attach a statement showing how you did your math. So, Section 1341 is your ticket to getting back your federal and state income tax. But that leaves one big question hanging, doesn't it? What about the FICA taxes, the Social Security and Medicare that you also paid on that bonus? Well, that's a whole separate can of worms. Those taxes are governed by a different set of rules, and getting them back requires a completely separate process, usually involving your old employer or filing a special form, Form 843 with the IRS. It's the final piece of the puzzle to make sure you get all your money back.